Following the clear downward trends of U.S. inflation and interest rates this year, we think the bond market in 2025 may prove a bit more complex to navigate. While there are risks around the extent of rate cuts and inflation trends next year, we believe investors can find a few opportunities in high-yield bonds, municipal bonds, and inflation-protected securities. Let's take a closer look. The high-yield bond market continues to benefit from historically high credit quality, above-average yields, and our expectation of below-average defaults. Healthy balance sheets and sufficient profitability to cover interest payments support strong fundamentals, and we expect defaults to fall well below the historical average of 4%. With yields above 7%, our expectation of low defaults and a supportive Federal Reserve are positive for investors seeking total returns with reduced volatility compared to equities. Strong fundamentals and yields also set up municipal bonds well for 2025. The average yield stands at above 3.5%, well above the 10-year average. Keep in mind that municipal bond income is tax-free for taxable investors. Based on the highest income tax bracket in the United States, the yield is equivalent to about 6% for a bond where income is taxable. Among state and local government bond issuers, we think healthy reserves, improved pension funding, and less debt provides a margin of safety from unexpected policy, economic, or other shock events. Inflation-protected securities, known as TIPS, are priced for near perfection, reflecting expectations that the Fed will successfully meet their 2% inflation target over the next 5 to 10 years. Currently, inflation, as measured by the core CPI index, which excludes more volatile energy and food prices, is above 3%. Even as inflation has come down, U.S. economic growth, high government spending, and potentially tariffs may pressure inflation upwards and challenge the Fed to meet its goal. By and large, we expect the path of inflation to be bumpy, making TIPS an important defensive portfolio component for unanticipated inflation. Increased bond yields over the past 2 years have been a dramatic departure from the low yields and returns that investors have experienced over the past 15 years. Looking to 2025, we believe yields will remain elevated for treasuries, municipals, and corporate bonds. However, in our view, these segments of the fixed income market offer fair compensation for investors and attractive yields relative to cash.